Money soldier, I thought I told you. Only rockin' with the agent and the broker, yeah. Move over, we getting bolder. Making moves like the agent and the broker, yeah. Generational wealth, they bout that. Yeah, we took some L's, but we bounced back. Financial literacy, got that. Closing up the wealth gap, yeah, I'm black. Welcome to the Agent and Broker Podcast, hosted by Julian and James. And you know they bringing nothing but that black boss talk, man. Cause there's no currency stronger than the black dollar. And it's time we let the world know. But first we gotta grow though, and that's for sure.
Peace, family. Hello.
What's going on, everyone?
Can you hear me? We all good? Sound good to me, brother.
Sounds good, man. You can hear me clear, right?
Absolutely. Sounds way better, man. I'm excited we got through that one, that rough patch in that week.
I know.
But again, welcome, guys, to another episode of the Agent and Broker Podcast. And I am your co-host, Julian, the agent, license W626089.
And I'm James, the broker, license number W282336 down here in Florida. It's like, man, I think I got a little bit too much, man, to relax. Not to remember my license number, right?
Oh, no. Can't have none of that, James. No.
Right?
But hey, guys, how y'all doing tonight? Today we won't be super long. Last week we kind of went over almost 2 hours, but
right.
This week we won't be as long as that. We'll try to keep it shorter. And pretty much what we want to do this week is kind of introduce you into what our topic next week will be with our guest interviewee. So it's a guy, his name is Hassani Houston. He lives in Texas. And he's an infinite banking expert. So tonight we're going to kind of introduce you into, that concept of infinite banking or savings through your life insurance policy. And today's topic of this episode is, why would I borrow my own money? And that is a common topic that you hear in the financial services industry, in the finance world. Some people just don't understand. A lot of people who buy term and invest the difference don't understand that why would I borrow my own money? So today we're going to break down what that means, and why we believe borrowing your money is a better way, to access your money with a life insurance policy.
Absolutely. Yeah, man. So today we're just going to debunk a little bit to, like Julian said, man, as an introduction to our next week episode, so you can have a good understanding. And we look forward for you to ask questions and reach out to us if you have any specific question that's too long to fit the comment. But yeah, man, very excited for this one.
Yeah, man, me too, bro. And it's doing a podcast, it just you don't even realize it how much you go through. And we're already on episode number 9 right now. And we're about to hit 100 downloads. So that's pretty cool, man. A little over a month, 100 downloads. That means we're getting a bit over a download a day, man. So last week we do like 16 downloads. So we're slowly creeping up, man. And I'm excited just to really get this information, this content out to the people and keep pounding.
Absolutely, man.
Like, pound for pound over here.
Absolutely. Thanks for all the downloads, man, from the bottom of our heart.
You guys.
We appreciate you guys, and keep sharing the content, because
please,
if you download this show, that means you see we're doing something significant here. So first and foremost, thank you. And we just look forward for you to keep sharing this so our community can benefit, can take advantage to a lot of the a lot of the things that's out there for them that they don't know about. So pretty excited for that, man.
Yeah, it's a exciting thing, and like James said, we appreciate you guys so much. Comment, like, share, and go leave a rating and review if you have Apple Podcasts. Please leave a rating and review. Google, YouTube, wherever you listen to it, or Spotify as well. That really helps us grow our platform and get the word out there to the world. So
Mm-hmm.
we wanted to let you guys, give you an update on that before we dove into today's topic. So, you got anything else, James, before we jump in?
I mean, no, man. I'm just looking to jump into this and elaborate on there so people can have a more understanding on about the regulations, why
Right.
certain things are there. Why is it sometimes you have to really challenge the way you've been, thought. You feel like,
Yeah,
man,
yeah.
like most things that as you're getting older, you're finding out a lot of things. You're like, man, have I been lied to?
Right.
So this is a vehicle when it comes to the IUL. You're really going to understand, why are they in place? When did they become in place? And what is the
Hmm.
true function behind them? And how you can take advantage of these, opportunities to build wealth. So yeah, I
Right.
mean, I'm very, very excited for this.
Yeah, absolutely, man. I agree 100% with everything you just said, and about IUL's whole life, IUL's universal life, and what we're about to teach right now. So, kind of diving into everything. So, why would I borrow my own money? It's a common question that you hear in as an insurance professional, or you maybe scrolling on Instagram, on Facebook, and you'll hear somebody like, "Why would I borrow my own money? How does that make sense? Why would I put my money somewhere and then I have to borrow it?"
Mhm.
And you know what? Like, it's almost like, how is this stuff even real or legal? You know what I'm saying?
Yep.
Like, because borrowing your money, whenever you take out a loan or anything of that such, you're considered borrowing money and you don't have to pay taxes on that money. So the
Exactly.
government, pretty much what they said was, hey, you guys can, as we get into the laws and the tax laws and things like that, and how life insurance played a role in the tax laws and what happened, the government was just like, okay, well, let's put some laws in place. Like, you can access your money in a life insurance policy tax free if the insurance company lends you, pretty much gives you the money in the lending position. So if they lend you the money that you have sitting in your policy, they'll put an interest rate on it, and now it's considered a loan. So now you're borrowing the insurance company's money while your money is still with the insurance company. Does that make sense?
That make perfect sense, man. But I
That's
know.
all. That's hard.
Yeah.
It's hard to comprehend, because
Hmm.
it's just like, how is my money? How can I, like, how's my money still sitting in there when they lended me the money?
Hmm.
And that's usually the next question always. And the insurance company is really, they're like your bank. So instead of you going to the regular bank, you're holding your money over here in the insurance company, and they're your bank now. So instead of having the first step, you're gonna go this step, then the next step of that,
Hmm.
that your actual bank, which are like, your Chase, your Bank of America, those big banks like that, credit unions, those are your banks that everybody typically knows about. But when you talk life insurance bank, people are just like, what? I've never heard of that. Well,
Hmm.
it doesn't make sense. So as we break stuff down, it's gonna make more sense for you guys, especially going in the next week, because we have a really good teacher coming in to really break down these laws for you guys and break down the steps how you can open an infinite bank, and the life insurance bank, as what is what James calls it.
Yep.
The first so the first person to do it was, who wrote a book on it, was Nelson Nash. It was, I think it's called Infinite Banking, and it started with whole life. So people would put money into whole life insurance policies and let that money grow, tax free, of course, and they would take away from it, borrow against that money. So you're getting about 3-4%, sometimes up to 6 or 7 with dividends included. So if you were to add those in, you can probably access to about 7% after you take all of the fees off of insurance. So
Mhm.
it started with that concept from whole life back in the 1970s. Universal life got introduced into the game, and then from there, what was happening was where people were putting $500,000 into the whole into the universal life insurance policy. So in year one, people was just like, okay, well, I put 500K. Let me go ahead and take out my money automatically or borrow against the policy. Boom, you're getting automatic growth in that first year, and people were taking the money out right away. So the brokerage firm, a lot of people don't know, EF Hutton, what they did was they started, structuring retirement accounts into life insurance instead of the 401ks, the qualified plans. Once they start putting money in life insurance, what happened was the IRS was like, wait, people are getting this amount of interest and not having to pay taxes on this money, all of this money, and they're getting all this growth and not having to pay taxes. So they came in and was like, hey, we're gonna have to start, put some new laws into the tax code. And as we go in, me and James will read, these laws and how they affected life insurance. So pretty much the government was like, okay, guys, y'all making too much money over here. We need to put a halt to this or slow it down a little bit. And then they put in different, little implemented little laws in here throughout that time period of the 70s and 80s. And I'm going to present my screen in a second, and we're just going to dig into these laws of, why the borrowing against the money, borrowing your money from the life insurance policy is beneficial. So let me share this really quick.
Mhm.
So, act number one, this is TEFRA, which is the Tax Equity and Fiscal Responsibility Act of 1982. Um, you'll probably hear this TEFRA, DEFRA, and TAMRA. This is the first one that Congress came to play. Was like, hey, this is the passage of the Tax Equity and Fiscal Responsibility Act in 1982, established that universal life insurance was in fact life insurance, but the law did define some characteristics of life insurance that must be present. Beyond this, TEFRA is a mostly dull piece of legislation concerning life insurance. So while many in the life insurance industry likely held their breath while the legislation was hammered out, its ultimate impact was minimal. It wasn't until 2 years later that the legislatures used the legislation and new legislation to slap the first set of handcuffs on life insurance. Again, the government is like, yo, let's slow it down. They people, so guys, I'll let James kind of break down. Just kind of tell them like how the government makes money on qualified plans.
Hmm. So I mean that's a really good one. I'm gonna break down for you. So qualified plan is when we're talking about your typical 401ks and your typical 403bs, other investment you're doing over there. So the government make a lot of money on that because you're literally putting your money before tax. You're putting your money there. They actually take that money and, of course, use it, put it in the market. Now, the thing is, you actually carry 100% of the risk as well.
Mm-hmm.
So even though you have a 401k or a retirement plan that's mostly very popular to the workplace, a lot of the time you're losing money, and then you have no say on there. Okay,
Right.
so government be able to actually make a lot of money on that. Now, as opposed to life insurance, why the government actually step in is because they feel like they're missing out on money. They're missing out on an opportunity. So every time you get to make money and you don't have to pay taxes, Uncle Sam got to step in.
Yep.
So there's a lot of I mean, I don't want to take that example. No, I'm not going to take that example. But anyway, there's a lot of thing out there that would actually be, I would say, okay for you to do, but just because there is no taxes, then it become illegal. For example, gambling. Gambling is illegal. You can't just gamble. But yet, if you have $20,000, you put it in the stock market, that is gambling. But
Right.
if you're in the corner street, you're gambling with your friend for money or whatever it may be, you're rolling dice. That's illegal, right? But the whole thing is you're not able to actually pay tax on that money, and they don't like that. So that's why these laws came into place to regulate the life insurance industry, because people was just making a whole bunch of money. The
Mm-hmm.
people who understood the system, the
Right.
people who understand the power of borrowing money instead
Mm-hmm.
of using their own money, they was making a whole bunch of money well, with the interest, and when they take that money out, they wasn't paying taxes.
Right.
So we're gonna break that down, but Uncle Sam say, hey, listen, I'm not making enough money, so we need to find out a way to regulate this. So which is kind of like, to follow back on what Julian said, they had to come with a strategy to make the money come out in the form of a loan. And as you
Mm-hmm.
know, if you didn't know, you're gonna know today. I'm gonna just say that on the back of my head, because I was listening to Doug Andrew, and that's why it's a little fresh in my head. So there's three ways you can be taxed. Okay, you can be taxed on earned income, investment, and your portfolio. So if your portfolio is bringing you money, then you need to actually pay taxes. If you are in a stock market and you make money, you doing crypto, you're making money, so that's capital gain, so you have to pay taxes. Earn income, you work in a 9 to 5, you have to pay taxes. But a lender can just put $300,000 in your bank account right now today. As long as it's a loan, you pay zero taxes. You ever ask
Right.
yourself why that is? It's a very, very powerful tool, and I hope you guys are taking note. Ask questions if you have to ask questions, but we're gonna go ahead and go over some of the regulations that it has been put in to regulate the life insurance industry, because people was just making too
Mm-hmm.
much money.
Right.
No.
Yeah. That's some gems there, man.
Mhm.
And kind of like to add on what you were saying about the government wanting to come in when people were making this bread. Like,
Yep.
I'm talking about people putting in $500,000 and gaining 100,000 in that same year. So it's like, all right, well, this is tax free, and the IRS pretty much was like, well, they tried to take this brokerage firm to court, and they ended up losing. And the reason they lost is because they're like, hey, this isn't an investment in vehicle. We're just minimizing the amount of death benefit that you allow as the IRS, that you allow for it to be considered a life insurance policy, and we're giving people the maximum amount of cash value. So that's where, EF Hutton kind of came in and changed the game for universal life insurance. People still kind of use whole life for infinite banking, but we look at universal life, index universal life, really as infinite banking on steroids. And
Yep.
next week, you guys are going to understand why, because when he comes on, he's going to break it down. It's going to be crazy. Like, I'm excited for that. That interview is going to be dope. And I hope a lot of people gain a lot of jewels from it. And today, like I said, we're just going to break down, the basics. So when you get in next week, kind of like you're kind of caught up where, he starts breaking down these little laws in here and how this stuff works. So just to get back to the next slide, which talks about, let's see. So the cash value accumulation test. So the cash value accumulation test was established mostly to handle how whole life insurance policies qualified as life insurance. The test is rather straightforward in the sense it merely tests the level of cash that can exist inside the life insurance policy relative to the outstanding death benefit. So long as this line is not crossed, the policy in question passes the test and is a life insurance contract. Kind of like I was saying about E.F. Hutton and how they start structuring the policies for it to still be considered a life insurance policy, it had to pass this cash value accumulation test. But they shrunk the death benefit to the least amount that the IRS allows, and they maximize the cash value, giving the clients those banging results. And
Mhm.
then James, you could read this if you want.
Yeah, of course, of course. So just to kind of like a little bit to add to what Julian said earlier on that slide, as a life insurance, you have to carry out, as a life insurance company, you have to carry some risk. You know, so if somebody put $500,000 premium in a policy and the policy cover $500,000, then where's the risk the life insurance is carrying? You know, so I mean, that's for you to really understand. Like, don't just take it from us, man. After you watch this, go do your research on Google or whatever search engine you use, so you can really get, you know, some more details on based on what you're looking to understand. But I'll go ahead and read this. The guideline premium test. So the guideline premium test was established mostly to handle how universal life insurance policies qualify as life insurance, though universal life insurance can qualify as life insurance using the cash value accumulation test as well. Um, the test has two different parts. Step one, it's an amount of premium that the policy holder is allowed to pay into the policy relatively to the death benefits. Okay. So, for example, if a policy has $1 million death benefit and the calculated guideline premium is 20,000 each year, the policyholder can place no more than $20,000 into the policy in any given year. Okay, so that's just to show you the regulation, because now if that person was to actually put more than $20,000 into that policy, now there is something called MEC, and I'm not going to go through there, but MEC is pretty much you pass the threshold of your policy. Now the gain, now you're probably gonna have to pay taxes on that. So the whole idea of using a life insurance strategy, or one of the main idea, is for you not to pay taxes. So it doesn't make any sense for you to cross that line where you're gonna end up paying taxes and the money. Then you wouldn't really be using the life insurance the way you know it should be used. And a beautiful thing about that as well is, just so you can avoid MEC, say you a pretty wealthy individual, well, you can actually open multiple of these policies. You know, it's not just like, hey, you open one policy and that's it. No, you can actually have multiple accounts, so you can really take advantage of these benefits. Because let me tell you, man, you're listening to this right now. You might say, what? If this is your first time hearing this information, you're like, what? You mean life insurance? Like, from today on, as you're listening to this, I want you to, when you think of life insurance, I want you to take the word death out of your mind, because the wealthy truly use life insurance for what it truly is: life insurance. Okay, it's a vehicle where you can literally not only getting your whole self and your family protected, but you grow your money tax free, not tax deferred, tax free. And when you withdraw this money, you also withdraw it tax free. And it's totally legal as long as you follow all the guidelines and it's set up the proper way.
Right.
But yeah, man, that's my part on that one, Julian.
Nice. It's that part is crucial right there. Just you being able to access money tax free, and when you pass away, it transfers tax free.
It transfer
Like
tax free as well.
that is crucial. And I remember sitting with somebody who is a big time executive at Primerica, and it's so funny. He tried to bring me on, to their agency. He's just like, we're agency building, and I'm just like, that's cool. Like, you guys sell term insurance. Nothing against term insurance, but when you're talking term insurance as one option, I'm now questioning things, because I just know too much information now,
Right?
to go back and tell somebody, okay, this is the only one you need. Term insurance, that strategy worked. That strategy works when you're a savvy investor and disciplined investor. So if you're going to buy term and invest the difference, meaning you're going to buy this term policy, and we covered this a few episodes ago. You're going to buy the term policy and you're going to invest the difference on that whole life. The amount of money that you're going to pay for a whole life at, say, $1 million, you're going to invest that difference. So whether that's $300, they're going to tell you to invest that every single month for the next 30 to 35 years. And you should get this amount of money to make up for that death benefit when that term expires. However, when you look at it, that leaves no room for error. You can't go through any trials or tribulations in life, no matter if something goes left or right, that leaves no room. So, excuse me, when you have a term policy, you have to be very disciplined enough to invest $300 every single month for the rest of the, almost your whole life, 30 to 40 years of your life. You're going to invest $300 to pretty much outbeat that life insurance policy that you would have had. And who knows where you're investing your money? That can be anywhere, like a mutual fund, the stock market, indexes. And we look at it like, hey, why wouldn't you just give your money to the insurance company who have some of the world's best investors? Like, they're the best investors in the world. When it comes to real estate, options, stock options,
Yep.
foreign exchange, anything of that such, insurance companies are the best, and they credit you for having policies with them. So it's like, why would I not give them the money and let them invest it for me, instead of me staying over here and putting it in this qualified plan or something like that, and letting that grow, and then allowing the government to take some from me at the end of that plan.
Mm-hmm.
So it was when I found that out, I'm like, okay, well, how can we bring more people into this, and bring this information to our people? Because we've been told to invest, buy term and invest the difference. But I can tell you, looking at people's finances, or even just seeing people in general, I know people not investing the difference. I know you're not investing $300-$400 a month every single month without missing a payment. You miss a payment, like, it can mess up your entire, strategy. If you miss a payment on a IUL, it's a flexible account. So, hey, call the insurance company. If you miss that payment, go ahead and hey, I'm not going to be able to make this payment this month. Can I reschedule for next? Boom. It's not going to mess up your future projections or anything. So, kind of going over that and really getting into those things of the life insurance companies, and how they invest their money. That buy term invest the different strategy is it's kind of going out of style.
Yeah, it's
And
outdated.
eventually, yeah, in our community is slowly getting there. So
Mhm.
this all relates back to buy term and invest the difference. So let me get back to the slide and kind of go through the next part. So, however, there are some other exceptions to these guideline premium and cash value accumulation tests. So there's allowance for both a one-time payment and an ongoing annual payment. If the policyholder chooses to make that one-time payment, that will be all the premium he or she would be allowed to pay towards the policy. Step 2 is a ratio of cash value to the outstanding death benefit that decreases as the insured gets older. This is sometimes referred to as the corridor, and why GPT is sometimes known as the corridor test. So that step 2 process right there, where it says there's a ratio of cash value to outstanding death benefit, meaning that, okay, the IRS they only allow, you need to have, let's say, $1.5 million in insurance, and let's say like 700,000 in cash value or something, maybe 1.1 million in cash value. You always need to be above your death benefit always needs to be above your
The
cash
cash
value.
value. Yep.
So it has to be a certain amount above your cash value for it to still be considered a life insurance contract. And like that word James said earlier, which was MEC, if it's not, you can be taxed on those gains now.
Mhm.
So this is something, if you're thinking about doing it, we always suggest, getting with somebody who knows these things about this policy, who knows these laws, knows how to structure them correctly and proficiently. That is a key thing, because a lot of people are upset, like, hey, my agent messed up this and messed up that. But When we bring the guy on next week, he will definitely explain more. Me and James, we know how to do them as well. So that's not a problem. If you are interested in opening one of these type of life insurance contracts, hey, you can definitely hit us up. We're open. We take what is it? We take I don't want to say it's not a consultation. So, we're taking appointments. It's not even a consultation. We're taking appointments. So we're open.
Yeah.
If you guys are interested in life insurance that looks like this, we are open for appointments with that.
Absolutely. And one thing we do before we go to the next one is we do an evaluation of your current situation, so we can make sure it
Absolutely.
makes sense
Got to.
for you. And also, I'm gonna just say that as well. And I know I said in the last episodes. So for all my listeners out there who heard of the concept buying term and invest the difference, buying term and invest the difference. Okay, just know that where that statement come from, is that this particular company, Primerica, was actually built to go against whole life. That was about, you know, close to 50 years ago. I think it's like 44, 45 years ago. I don't know. Don't quote me on that. But when they came out, the whole idea was to go against the whole life. And now you kind of think about it, they still have the same mindset, even though we're in the 21st century. It's kind of crazy, right?
Yep.
So some stuff just sounds good, but at the end of the day, it doesn't fully work the way it's intended to work. And I've been approached with them so many times, and I've been to so many conversation. It's just like, I mean, once you do your own research, you kind of figure like, well, I don't think that's the only way out there. So you owe it to yourself to do your own research. You owe it to yourself to educate yourself, and then make an educated decision and take advantage of what really going to benefit you. Because that
Hmm.
one thing we can say is, um, when you invest with a life insurance and a life insurance product like the IUL, one thing that is guarantee, and yes, we can say the word guarantee, is that you will never lose a dime no matter what the market is doing.
Yep.
You go down 20%, you go down 30%, you won't lose a dime. As opposed to regular investment, you know, it goes up and down, it fluctuate with the market. And if you do have investment out there, I just want you to think of this. I always encourage people, should always, you cannot put all your eggs in one basket, especially if you have the mean and if you have the ability to actually invest into different account. However, this is what I always tell people: if you decide to put all your eggs in a one basket, where you fully vested into the stock market, and then here you are, maybe you want to retire, and you 62, 64, 65 years old, and then we happen to be in a recession, we happen to be under COVID, we happen to experience another 2008, we just happen to be experiencing some turmoil, war, whatever it could be. Guess what? Now
Yep.
the stock market is down, so is your retirement money.
Hmm.
you know, so is your retirement money. So you don't want to gamble your whole retirement away. So that's why I always encourage people to look into an IUL, and then see really, what it can do for you. But yeah, go ahead, Julian, if you want to go ahead and read this, or you want me to read it.
Um, well, just kind of to clear up some things, guys. It is not if if the financial services industry is listening to this, it is not an investment. So life
Right?
insurance is not considered an investment. We can't call it an investment. However, your house, some people buy houses. Don't look at that as an investment. It's just how you look at it. However you want to look at it is how you look at it. But we're not going to call it an investment. Again, remember why? Because investments lose money. We don't want to lose money. So life insurance is almost like a guarantee. You know what I'm saying? Like we're
Pretty
gonna
much.
guarantee we get like 5-6% on our money. But okay,
Compound.
yes, sir. That's compounding. So kind of going into the next act, which is DEFRA of 1984, the Deficit Reduction Act. And That was coordinated with language laid out in TEFRA from 2 years before to establish specific rules about what life insurance was and what life insurance was not. So, more specifically, upon DEFRA's passage, we now had a specific limitation on premium size relative to an outstanding death benefit that qualified or disqualified a life insurance contract as life insurance. It's easiest to think of these limitations as tests in the sense that failing the test means the premium amount is outside the allowable limit, and the limit is a function of the size of the death benefit. These are actually two tests: the cash value accumulation test that we covered before and the guideline premium test. So, like I was saying, all of these laws came into play because the IRS really wanted to slow down people's money. If people are hearing about, okay, I can come over here and put $500,000 and get $100,000 after the first year and take it out tax free, most people were running away from qualified plans. Most people, there's no reason to even be in qualified plans. So, okay, when they took E.F. Hutton to court, they lost the case. The IRS lost the case because E.F. Hutton proved to them that these were considered life insurance contracts. They weren't any investments or anything. Now, when they won that case, the government was like, okay, well, since we can't take that away, let's slow it down here. So there has to be a certain amount of life insurance death benefit, and your cash value must, be less than your death benefit always. But they also implemented laws into life insurance to where, okay, well, if people are withdrawing their money tax free, how are they going to do it tax free? The IRS said, hey, okay, life insurance company, you guys pretty much call it a policy loan. So charge them, 4, 5, 6% on interest every single year. If they're going to charge you on interest on your loan, pretty much like they'll allow you to borrow your money that you have in the account. So if you have, for instance, say $50,000 in your account, and it's allowing you at this moment, you're allowed to take out access up to $40,000. You don't want to go to the life insurance company and tell them, hey, I want to withdraw $40,000. There's a difference between withdraw and borrow. So when you get that EFT form, or when you want to pull out of your account, you want to borrow instead of withdraw. I personally seen someone withdraw the money years ago in their policy, and that money is no longer there. So obviously the agent that structured it, the agent that did it, didn't know what they were doing. They allowed the lady to withdraw the money, and she had a loan. Really, she had a loan balance still on there. However, the good thing about life insurance loans is they don't hit your credit score. They're not you don't have to pay them back. However, we don't suggest not to pay it back, because if it's going to be a bank, you want to pay yourself back pretty much. But they're not like, okay, if you don't pay this back, we're going to shoot your credit, or we're going to, come after you or anything like that. Like, no, that's not the case. They just really will deduct it off of your death benefit at the end when you do pass away. So the IRS came and was like, okay, let's slow this down. Let's throw these rules here. Okay, you can't have this amount in here for it to be considered life insurance. And then we're going to call it, we're going to allow them to loan people the money now instead of them withdrawing it. So they're not taxed, and it's not considered a taxable event. And that's kind of how that came apart. Like, pretty much just laws, things happening, and the IRS kind of like low key hating on the low.
Yep.
All right, well, we got to find a way for us to slow these things down. And that caused a bit of confusion and trouble and, wavy waters in this industry. And people, it kind of slowed it down, but still there's ways around it. So we're going to let James go on to the next one, which is TAMRA, which is the last act that was put in 1988.
TAMRA, 1988. That's when I was born, by the way. So if you want to guess my age, All of a sudden, you just remind me of how old I am, Julian. But anyway, Congress Act, the Technical and Miscellaneous Revenue Act, TEMRA, of 1988. Um, the TEMRA of 1988 laid out one additional restriction on life insurance. That's all they're doing, trying to restrict life insurance. A new test that limited premium paid to life insurance policy to essentially the premium needed to cover all the guarantee of the contract spread out over a 7-year period. This is why we call it the 7-pay test. It actually exists. If a policy violated this rule by paying more than this amount, he or she didn't lose his or her policy status as a life insurance per se. Instead, the policy was reclassified as a modified endowment contract, which is MEC. When I said MEC earlier, that's what I meant. Okay, so that means now you have to pay taxes on your gain. Okay. But anyway, this is some pretty cool stuff. One thing you have to tell yourself is whenever Uncle Sam decide to get into to start regulating something, you need to pay attention to it.
Absolutely.
You need to pay attention to it because it's a big opportunity. All right. But yeah, that's that part, man.
Thank you. And so kind of going over that TEFRA, DEFRA, and TAMRA, pretty much like, hey, we're gonna allow your money to grow tax-free. You can access it tax-free, and then when you pass away, it distributes to beneficiaries, trusts, wherever you want it to go, tax-free.
Tax-free.
So honestly, guys, life insurance has been put as death insurance on us for years. And now understanding and knowing this information kind of puts us ahead of the game, honestly. Like,
yep.
If you know that your money, if you put it over here, it'll be tax-free. If you ever to go through anything like in life, hard times, emergencies, anything of that such, your money is over here gaining interest in the life insurance contract. And if you ever needed to access it, it's a phone call or EFT form away. Hey, I need to, and you want to access it the right way. You don't want to do it the the not so smart way, because if you do that, you'll really mess up your policy. And that's happened to a lot of people. They go and be like, hey, I want to withdraw. I want to take out, $40,000 out of my policy. The insurance company is going to ask you, do you want to withdraw that money or borrow that money? And we have such a negative perception and a misunderstanding of loans. When we think of a loan, we look at it as bad. Like, oh no, I don't want to borrow any money, because we automatically think we're going to owe somebody back. We think that, if I borrow this and I'm not able to pay it back, it's going to hit my credit. It's going to, just mess up everything. We think of student loans, everything where you have to pay it back. But really, you want to start looking at this as a loan, really, to leverage. So if I could leverage a loan, I can leverage this money. If I could leverage $40,000 and not pay any taxes on that money, instead of, paying, entering like a 401k policy and taking the money out of there, where if you're under, 59 and a half, they're going to tax you and penalize you. So you're automatically losing money right off the rip. But if you come over here like, hey, I would like to borrow instead of withdraw, let me borrow $40,000 out of my policy. The insurance company will send you your money right away to your mailbox or EFT form, sending it right to your bank account in 24 to 48 hours. So when you talk about liquidity, the insurance passes the liquidity test. And whenever you want to put, money into investments or anything of that such, one of the things that a prudent investor really loves is being liquid in times of uncertainty. And COVID showed that. So whenever things like the market crash, or even back in 2008, 2009, people who had money sitting in their houses couldn't access their money, because when the market crashed, you're no longer able to, get that equity out. They're not giving out equity loans. So if your money isn't in an account that's liquid, you probably might want to start, reconsidering some things. Maybe, looking at talking at some tax advisors, some savvy CPAs and people like that, because one thing you want to do is keep your money liquid at all times. Like, qualified plans aren't the most liquid at all. You got to be, again, 59 and a half, older than that, to access it without being penalized. You also got to pay taxes on it if you do
Taxes.
access. So being liquid is probably the number one thing to being a prudent investor. And most people think it's rate of return, but really it's liquidity. How fast can you get your money in times of uncertainty? How fast can you access it? And with a life insurance policy, you have the ability to access that money as fast, 24 to 48 hours. It's your money. They can't tell you no. You don't have to get a credit check to go access your loan. You don't have to, go through hoops and background checks here and, different things that you would see at a regular bank. You can kind of skip the bank out the way and go straight to the insurance company and like, hey, I want to borrow my money. And that's literally as simple as it sounds, honestly.
Yep, 100%, man. Borrow the money instead of withdrawing the money from the life insurance company. And just to, I mean, I want to put it into perspective for you. There's this guy who actually explained it really well. So imagine you just add one more step on the way you spend money. Just add one more step. So say you're gonna spend $100,000 a year, right? So what you do is you take $100,000, you give it to the life insurance company. Okay, it's right there. And you tell the life insurance company, hey, I still need about $80,000 to pay, what I need. So I need $80,000, but I don't want you to give me my money back. I want you to keep my money and make sure it's working and get interest.
Right.
That's exactly what you're telling the insurance company. But since I have $100,000 in your bank, I want you to give me $80 and use my $100,000 as a collateral, if anything. So now here you are, insurance company give you $80,000. What do? You pay your car note, you pay this, you pay that, and really the lump sum is still there, accumulating compound interest.
Right.
So I just wanted to kind of like specify it for you guys, because I mean it's truly a beautiful product, man. And sometimes it can sound like it's complicated, but it's really not. It's really just adding that one step into your behavior, and where you're actually borrowing money from yourself, and the interest paid back actually go back to yourself as well. And then your money just stay uninterrupted, gaining interest.
Right.
But if you just use your money, if you have $100,000, you use $80,000 out of it. How much you have left? 20 grand. That's it. But if you go the other way, then you're still gonna have $100,000 plus your death benefits, plus living benefits for chronic illness, terminal illness, and so on, plus so much more. So if they're not talking about it enough, know that is very important. You need to seek the information for yourself.
Absolutely. You gotta go, and you want to read the right information too, because a simple Google search can scare you away from this. Honestly,
that's true too. Yep.
It's if you Google this stuff, it's kind of like, it almost like, dang, is Google against us from learning the truth? Like, because when you get into SEO and all of those paid search strategies, where all of the companies like Forbes or Business Insider and all of these companies who do articles, they rank the highest on Google search. So when you look at the first page, you can see all bad articles, but really the articles and the books that you need to read aren't really mainstream. So things like tax-free wealth by Tom Wheelwright. He mentioned the name of the game is to control everything and own nothing. So, meaning you want to be able to leverage other people's money, like the bank, the life insurance companies, anybody else's money. You want to leverage investors, you want to leverage their money and control whatever that asset is. So you can utilize life insurance to buy real estate. If you needed a down payment, you had $100,000 in your policy, like James said, you can literally borrow from the policy. If you needed to put $20,000 down to, get what, a $400,000 house or a $300,000 house, you want to take out 20, 25 to 30K, you can do that with the life insurance policy and go and purchase an asset. And now you can control that asset with a mortgage. If you want to go rent it out, you can do that as well and have somebody pay your mortgage note off while you're controlling it. So if you're able to cash flow from that, which would be the best thing to do, you don't want to go into it if you're not cash flowing. If you're able to get some income out of that house every single month, you just literally leverage the life insurance company's money, which is your money, but you leverage their money to buy this asset that's going to make you more money. You know what I'm saying? So like there's so many ways you can utilize life insurance to, go in and purchase, cash flowing assets, or even pay off certain things like the car, or even you can use it as a mortgage. Literally, if you have that money, that type of money, like $400,000 in your policy, like you can mortgage your own house if you wanted to, and then just pay yourself back. And throughout the time that you're living there, you can just pay yourself back and keep putting the money back into the policy, because again, it is your bank. So you obviously want to fund your bank properly and pay your bank back. And the bank will take care of you. And that's how it is. And that's the beauty of it.
That's the beauty of it. It's a beautiful thing, man. And I was actually watching this other guy who did a really great job breaking it down. And what I just explained earlier was actually from that same video. It's almost like a 2 hour long, but he was telling a story how he met a professional. I believe he was a chiropractor. Actually, Joe actually shared that with me. Thank you, Joe. Joe, the realist, if you're watching this, he actually shared that with me. So he met this chiropractor, and the chiropractor told him he wasn't like 400 something $1,000 in debt. And when they did a financial analysis, they find out that he was making $25,000 in cash. So people who come to his facility pay cash. He take that cash and put it in a bank. So when they calculate the amount of debt he has, it would take almost 20 years to take it off, to pay the whole thing off. By changing that one thing, he was able to pay everything off in 6 years, almost 7 years. Jeez. So how did that happen? That same $25,000 he was getting a year, instead of putting it in a regular saving that's not giving him anything, they put that money into an insurance policy. So every year he was putting $25,000 into that policy. And what he does is he actually just go and borrow against it and pay stuff out one at a time. And then he keep replenishing it, 25,000, 25,000. At first, he was able to borrow at the first 25,000. I think he was able to borrow 60% of it, right? And then he go up to 80%. And then at one point when he was borrowing the money, he'll put 25,000 where he was able to get a little bit more than 25,000. But how is he able to do that compound interest? Because his money never got interrupted, even though he was taking money out the policy.
Yeah.
Okay. So because he used that method, he only had that one thing, which is becoming your own bank, pretty much as the term a lot of us we use. Just adding that one method, he was able to pay all his stuff throughout within like almost about 7 years, which is a very, very powerful tools, man. So I thought I'd give you that little story, in closing.
Yeah, that was a good story there, man. It's, man, honestly, if used right and correctly, man, it's really a game changer for a lot of people. And of course, everybody doesn't qualify for it. So it is a life insurance contract, and you do need to be disciplined. If you're going to do something like this, I encourage you, if you don't have the money or the financial habits to do these things, like, be your own bank, start like a mortgage lender would tell you, hey, we need to see for a year, we need to see you put away $500 here. So for the first year, you put away $500, you save $500. When you hit that 1 year mark, you could open your bank, and that money that you save, that $500 a month you save, what is that, 6,000 a year? And you can just put the entire 6,000 into your life insurance policy or your bank that second year, and now you have started your bank process, and now you can just keep saving again because you've paid off your annual amount for that year. So you got a year now to save again and do the same thing and double back the next year. Now you're up 12,000 inside of your bank. And another example, like, I'll put $1,000 into it. So by the next year, I'm at $12,000. I'll be able to access up to about 80% of that. So I could access up to about, I'll say about like 10,000. But I'm not gonna do that. But what I could do with that is a year from now, I can get 10,000 if I want it. I could pay, a down payment on a property, or I could go and buy a cash flowing asset that can really make me money and help pay that $10,000 back and replenish it, even though I'm going to do that regardless. But the name of the game is to always keep replacing the income. If you're going to take out, you want to be putting back in. So
100%.
those are examples where if you don't qualify, because everybody's not going to qualify for that bank, you got to have good health. Again, your health has to be, decent, up to par. No cancer, no terminal illnesses, chronic illnesses, things like that kind of affect when getting a infinite bank. And some carriers are lenient with it, so just really depending on the carrier and who you go with. So I just wanted to drop that before we did end the podcast tonight, that everybody may not qualify. And next week, when we bring on brother Hassani, he's going to explain who does qualify for that bank, and how you can get that bank started. And I think one of those strategies about saving every month of the first year before you open that bank is something he will mention, because that is important to do, and you want to build those saving habits.
Mm-hmm.
Those are important.
Saving the right ways for your own
Yeah,
bank. You create your
absolutely.
own banking system, and is if you see, when the next time you see Chase open a branch next to your house, or Wells Fargo or Bank of America, they're just extending to another branch. Just think,
Hmm.
man, that could have been me. You know how that could have been you? You get your first policy, you fund it well, and then you open another policy, that'll be your second branch.
Yeah,
So you're branching out and
there you
really
go.
build that income. Okay,
Different
because
bucket.
everything you've been taught about credit, most of them are actually wrong.
Yeah, everything we've been taught is pretty much wrong, or we've been misinformed about information like for years. And it's a constant way of learning. It's almost like information overload. Like, oh my God, this is too much. Let me back up and start right here, and work this method out, because it is a lot. This stuff goes deep, guys. You talking about the tax code, getting into things like that, and the laws, and understanding credit, how to leverage your credit and leverage who you are as a consumer,
Mhm.
and your social security number. It gets deeper and deeper. And I do want to bring somebody on to talk about credit eventually as well, so people can understand, credit, how that works. I mean, I could talk about it, but that would defeat the purpose of the agent and broker, really. But
Mhm.
bringing somebody on to really, speak credit, and helping people get their credit right, so they can go and purchase that first property. But also, credit is based off of your financial habits, your habits, man. Like, how are you spending your money? How are you making decisions? And that's what that will reflect. When you look at a
Mhm.
credit report, it will reflect everything about you as a person. And I could look at somebody's credit report and tell you if this person is risky or not. And that's the same thing the bank does.
Mhm.
Same thing an insurance company does. Like, before they approve you for a policy, they go and look at these third-party companies like LexisNexis, and they go in and review your entire report to see like what do you have on there, repos, any major collections, anything that would be a red flag. Like, okay, I know they won't pay their policy out, so or pay these premiums on the policy, so I don't know, their risk is a little high.
Mm-hmm. Because I mean, the insurance company, they're looking at the number one thing they're looking at is the risk. Now you're
Mm-hmm.
looking at this as an opportunity. Oh man, I can make what? 6-7% compound average a year of my money? Yeah, sign me up. But they look at you and say, whoa, 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 time out. You got to go through, some filters.
Yeah.
Do you know? I remember, I think last year or almost 2 years ago, there was this guy who, like, he really needed a policy and he wanted the policy. He got denied. Now, he didn't get denied because he was sick.
Mm.
You know what the funny story is? He got denied when we actually said, well, we actually get on the phone and we talked to the underwriter. They literally said, well, this guy, he never stay on an address for more than 2 years. He's
Yeah.
always moving,
Yeah.
and he owe some money, so his credit is not there. So the life insurance company said, no, we don't think this person qualify for our services
Mm-hmm.
because this person cannot even like take care of themselves. They
Right.
look at all this stuff.
Yeah.
Like you're 40 years old. What do you mean like you're moving like
You're
every single
risky.
year? Like now you're
Yeah.
risky,
You're risky.
you
Like
know?
you
Yeah.
taking risks, and people will be like, yo, it's racist and all of this. Yeah, true. But at the end of the day, you got to look at it too in the perspective of doing business as well. How would you feel if you was lending somebody money, or you promised to pay somebody out $1 million if they paid you this amount of money, but they weren't able to hold up their end of the bargain? Would you still expect to pay them, that money out if they
Mhm.
didn't agree? If y'all agreed to like 20 years, if they pay you for 20 years, you'll pay them out if something happens to them. But they didn't hold up their end of the bargain, and you didn't get to pay them out. And their family comes and they're mad, like, oh, they're racist. They didn't pay it out because we're black, or things like that. But no, you got to look at it as a business decision. If you're lending your money to somebody and they're not paying you back throughout your agreement, then what do you do? So really, if I'm gonna look at somebody, if I'm thinking about, possibly supplying this person a benefit if they happen to die, or even if it's a cash value policy, I have to look at their risk factors and
Mhm.
in areas of financial decisions, as well as stability. Like moving from address to address is super risky. That looks risky to banks. So you're getting
Mhm.
denied credit, you're getting denied a loan, any type of things like that, because you're showing that you're not stable.
Yep.
You can't stay in one place if you're moving every single year. So insurance companies look at that as well, because this is a business decision too. We're agreeing to allow you to pay us premiums. In return for those premiums, we will pay you, your family or beneficiaries, whoever, out a death benefit if you happen to pass away, or if you were to get terminally or critically ill, we will allow, a death benefit to you. So we have to look at all of these things before we do issue this policy. And that is something that is important to know before opening your bank, guys. So what we want you guys to do is get your health together, get
Mhm.
your financial health, your physical health, all of these things in order, because when it comes to when to open this bank up, those things need to be in order. And you'll start seeing changes in your life when you start making those moves. You start looking at your finances more, start identifying those things alone. Yeah, you'll be
Mhm.
good.
It's a big move. It's a
Yeah,
big move.
huge
It,
move.
it gives you a shift of paradigm.
Yeah,
You know,
absolutely.
your
Big
whole
paradigm
mindset
shift.
change, man. So,
Big paradigm shift.
oh yeah, oh yes.
All right. So next week, guys, we are live again at 9 o'clock p.m. So we're moving back to Mondays with our interview, which is great. So we'll be hosting the brother Hassani Houston. Um, you can find him on Instagram as well. Go follow him. His page has been blowing up like crazy. So I definitely want to give him, his props for that. So His Instagram is HZ Houston 12. So that's HZ Houston 12. You go find him. He's like the man when it comes to infinite banking. He helps professionals accomplish financial independence through leveraging infinite banking by spending the same dollar twice. And
Yep.
that's sending it to the insurance company and coming back to your bank. And that's how the strategy works. And I followed this guy, reached out to him probably early February. He had about maybe 3,000 followers. Man, I'll tell you, by the end of February, right now he's sitting at 10.5K. His content has been going crazy on the infinite banking strategies, and people want to know more. People want to get involved. How do I open my own bank? And he has to break those things down. Like, everybody may not qualify, and that is the one thing about infinite banking. And I'm excited about this interview. It's going to be dope. Hope
Yeah,
you
man.
guys are able to attend the live. It probably won't be released to another like 3-4 weeks because we're kind of backed up on releasing podcasts because we overloaded kind of in the last 2 weeks. So we're probably like a week and a half behind on those releasing on iTunes and Spotify. But you can catch it on YouTube. Of course, you can catch the rerun of the live podcast when we go live. So that is one thing you can do, is catch the rewind on there. So before we close out, James, you have anything else you want to say?
Man, I just look forward to next week so we can
Oh
have
yeah.
a really, really great conversation with him,
Oh
and
yeah.
just bring value, bring content, and hopefully you guys like this content. Share it. Leave a rating for us on one of the platform. Download
Please.
it. And really, we're just two young men who's just like, we find out about a lot of great information, and we decide to come out here and share it to
Share it.
you, and make a very educated decision for your financial future. Because
Hmm.
especially in our community, I say that so many times. If you want to look at your future, um just kind of look at your surroundings, and if your
Yeah.
surroundings, you're not doing anything different than what they did, then that's most likely, 2 plus 2 is 4. That's where you're going to be. However, if you don't like the result, you want to become something different or someone different to create to stop that curse.
Hmm.
Then these are the information that is very, very highly recommended for you to dive in and take advantage of what the wealthy has been taking advantage of. Man, I've been in this industry. I've been licensed since 2015. Um, Let me tell you, man, this is probably one of the best decisions I've made, because I learned so much, not just about the industry, but it just make me become a better person and more attentive to finances.
Hmm.
So I look forward to the next show. I look forward to continue to bring you value. And Julian and I, we want to say thank you again for all the downloads. Almost 100 downloads within the 30 days. That's pretty big. So
Yeah.
next month, we can maybe take that to we can compound that, right?
Let's keep
So
compounding it, y'all.
help
Yeah.
us compound it,
Yeah.
man. So
Keep sharing. Keep showing. Your friends, your family. Let everybody know, like, we are giving you guys this information. And if you ever feel like you want to take the next steps in purchasing life insurance, feel free to reach out to James or myself. And you can go to our website, theagentandbroker.com. Fill out the form, and we will get in contact with you. We'll come to your house or meet with you via Zoom and kind of go through your finances, guys. It's okay. It's time to get uncomfortable. We're in a times of uncertainty right now, so you don't know what's going to happen in the next few years. You don't know if there's going to be any more middle class. We don't know, like, the way taxes are going. Like, there's things that are changing drastically in a fast
Mhm.
pace. So in the next 3, 4, 5 years, it may be just a rich and a poor. So we want to be prepared for those times of uncertainty. So please feel free to reach out to James and myself, and we can help assist you any way we can. If we're not able to, we do have resources to get you
Mhm.
and point you in the right direction. Like our sister Crystal from last week. So that was a really dope interview, and I'm excited for our next one as we go forward next week.
Mm-hmm. So if you didn't catch the one with Crystal, make sure you watch out for it. Yeah, go find it on YouTube. Scroll back up to the Facebook. Oh my God, this was fire. I think we went like an hour and
40 plus minutes. Yeah,
hour and 40 plus minutes. So that should tell you how intense that was.
Yeah,
so it was a really good one
too. We could have went even longer.
Yeah, because we didn't even go through all the questions,
we didn't. But for sure, like, guys, digest this information, take it, tell a family, a friend. Agent and Broker Podcast, iTunes, or Apple Podcast, Spotify, and Google Podcast. You can find us on YouTube at LVNU Financial. You can go subscribe to our YouTube channel and watch all of our rerun episodes. You can get all the information you need there. And then also our website at the end, which is theagentandbroker.com. And we have some more dope events we have coming up. So stay tuned.
Yes, sir.
Yep. Y'all have a good one.
Have a good night, everybody.
All right.
The agent and the broker put you on the right path. And if it ain't adding up, then do the right math. And when you wanna come up, some might laugh. But them be the types to be the overnight staff. Always be a worker, we tryna be some owners. Sometimes might strike out, sometimes we hitting homers. But one thing's for sure, when the money gets uncovered, hit the agent and the broker. Say thank you to my brothers.